This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self Storage Podcast. I am your host, Scott Meyers, and at the time of this recording, we are in the middle of the COVID-19 pandemic. And as we are all adjusting to our new norm personally, I wanted to bring in some guests who are very entrenched in the industry to shed light on how they and their companies are reacting to the changes in our economy and in our industry. Well, in today's episode, I'm having a conversation with the two brokers that I do the most business with, and that is Ann Williams with Marcus & Millichap and Jesse Luke with EquiCap Commercial. Ann has been in real estate for over 25 years and got into self-storage 20 years ago working for Storage USA, which is now Extra Space Storage. And in 2006, she joined Marcus & Millichap, where she provides advisory and brokerage services to owners and operators solely in the self-storage business. Ann also joined our team back in March 2011 as a mentor and has helped dozens of our students achieve their dream of getting into the self-storage business. Jesse is also a commercial real estate broker who operates exclusively in the self-storage marketplace since 2006. For a number of years, he worked for a large firm before opening his own boutique office in 2009, where he also focuses primarily on buyer and seller representation of self-storage properties located in the Midwest, Mid-South, and Southeastern markets. Jesse first represented me as a buyer in 2007 and has been mentoring our students as part of our team since 2010. Now, I am extremely grateful that Ann and Jesse took some time out to share what they're seeing in the acquisition and disposition activities in the marketplace at this time. So, without further ado, let's dive into my conversation with Ann Williams and Jesse Luke. Ann and Jesse, welcome to the show.
Thank you.
Well, thanks for having us.
Well, so what we wanted to talk about today is a lot of questions coming in from folks everywhere, including myself daily. We're looking at not only the capital markets, but what sellers are doing, what developers are doing. So thankful that you guys took time out of your busy schedules to talk about what the acquisition and disposition markets look like. So with that, I don't really have any specific question other than to say to both of you, what are you seeing in the marketplace right now from both sellers and buyers? Ann, we'll start with you.
Well, I mean, to some degree, it is a little business as usual. Buyers and sellers are still have the same motivation that they had. Still feel, sellers, and I'm still getting the calls from owners who considering selling or wanting to know what their property's worth for the right reasons or the same reasons they were 60, 90 days ago. And buyers are still wanting to transact for the same reasons they were. Kind of the headwinds I'm seeing, if you will, is really on the lending side. And it seems like every week we find a new headwind in that world. But that's probably the hiccup right now that we're running into. And lenders have gotten a little bit more conservative on their underwriting, got more conservative on the loan to value and even their debt coverage ratios. So with that, borrowers have got to step up with 30, 35% versus 20, 25, and just be prepared for longer due diligence times with the lenders. And but as far as the buyer and seller, I think it's, their heart's in the right place, but we've just got to navigate the lender waters. But if you've got cash right now, cash is king.
We'd seen an uptick in activity on our end from our marketing efforts and direct mail, and then it seems like either they pulled those old mailers out or our phone numbers, and where the low-hanging fruit, if you want to call it that, has now been gone for maybe even over a year for the folks that were in a position to sell. And for whatever reason, as we were asking some of these folks, and some were telling us and some maybe not, but I think that maybe some folks were scared now and they just realized that they didn't want to weather another recession, or they didn't know what would happen to valuations. And all of a sudden we saw anywhere from probably a 15 to 20% uptick in inbound calls, folks that received their mailers that are now thinking that it's time to sell. So Jesse, I know you do a lot of that as well. Were you seeing that, or I guess same question goes to you as to Ann? What are you seeing on that side? The existing folks that have facilities. Is it now time to sell?
Yeah, I think that's a good question, and to address the first talking point about what's going on in the market. Today's Wednesday. Since Friday of last week, we finalized 2 purchase agreements and actually working with Ann on those on deals in Dalton, Georgia and Chattanooga, Tennessee, 6.5 cap and 7 cap respectively on trailing 12. So, we're not dipping into an increased or inflated cap rate expectations from the buyer's perspective yet. We finalized this week on yesterday signatures on a development deal here in Chicago. And we just sent this morning, last final drafts of a purchase agreement for 2 deals, one in Chicago and one in Milwaukee that an investment fund is buying. So, and again, those are, those cap rates have a 6 in front of them. So, from a stabilized private buyer or stabilized deal that a private buyer is buying to some properties that have a little bit of add value component to them that a fund is buying, we're seeing fairly aggressive cap rates. We're seeing strong activity. We're seeing strong interest, and everybody's moving forward in the right direction. That same fund wrote an offer on 2 decent-sized properties in Memphis through Ann. Yesterday, 2 days ago, we delivered those offers. So, again, I don't think we're seeing any wane in activity, and I think that both the individual owner operator and the funds that are working through management companies, they're making runs at well-positioned assets that they can identify some level of add value component to. With regard to your second question, I'll tell you, I don't feel the phone ringing as much over the last 4 to 6 weeks. However, I do see an increase in activity to different levels of, different campaigns that I send out. So, for example, I sent an email campaign for a 1031 buyer that was looking to place some capital. And we got a tremendous response from folks that previously had not responded to those types of campaigns. Some of them were just kicking tires to figure out what the market looked like. Some of them, wanted to know, what the next 6 months to a year looked like and whether or not it was the right time. And some people were actively looking to make a move right now before, they were backed into a corner and reacting to the market. They were taking a little bit of a proactive response. That same message goes for some buyers. As we're marketing a property in Louisville, for example, I'm getting phone calls from buyers that I've never spoken with in the past. They've been on my radar, they've been in my database, but they've never reached out to us for the products that we're offering. And now they're circling the wagons and looking at deals that we're bringing to the table. So I think it's a positive sign in that regard.
Yeah, I was just going to ask on those folks that are coming to you for the first time. We have a little bit of a sense of urgency over here that we feel like now is the time to react, and then is not the time to wait because we don't know what's going to happen with the financial markets or even the inventory levels. So we have doubled down, and we all know that self-storage does extremely well during a recession. And so for those folks from the middle managers on LinkedIn that have a 401k because they've been let go, they're not just furloughed, and they have to put their money to work for them, or they need to, invest again for the long term, to, the folks that were in some cash flowing investments before that are looking to put their money to work. Anywhere you go on the internet, if you're looking, you type in recession-proof, income, or recession-proof passive income, or recession-proof business, all roads lead to self-storage. So that was going to be my next question. Could both of you maybe elaborate on that a little bit in terms of, we're seeing some of the family offices come to us. Some of the insurance companies are becoming more active. So some of the players from the fund side that either have been investing in self-storage before and now they're amping it up, but also some new entrants. What are you seeing in terms of the buyers and their sophistication, and what are they looking for?
I think, we've seen a lot of that. It is very attractive, and even this week we had a lender, as you know, the CMBS market is kind of kicked to the curb right now during this economic climate that we're in. But as we're sourcing funds for, a $6 million deal, and we're dialing lenders left and right, trying to find some good terms, a CMBS lender actually said, "Oh, it's storage? Yeah, I'll lend on that." So, we continue to be the belle of the ball, because we have proven 10 years ago to come out of this, somewhat unscathed, if you will, but recession resistant. Certainly aren't taking the hits that our retail friends and certainly our hotel friends are taking. I think the single tenant properties for now are still doing pretty well. But, storage just continues to be, I can argue both sides of the coin for as we lose customers, some people want to debate, well, people are going to move out because they can't afford it. Well, I came from the management side of this business before I was on brokerage. Some of my lower income areas were some of my best properties, where if they wanted, that was the last thing. If they had to write something, they were writing a check to their storage because they wanted to keep that. But we'll lose some customers. We'll gain some customers. I think what we're watching right now is just the delinquencies. I think Jesse and I talked to an owner yesterday. It said they were down or running about 2% more on their delinquencies right now. And I think that can be an owner perspective. A lot of owners right now are empathetic. They're not foreclosing. They're not trying to collect those late fees. They're trying to give some relief to these folks. What'd be interesting to see is how quickly we can get caught up, over the next few months as foreclosures get back in and we start auctioning some of these units. But yeah, the funds, they're being developed. I've got a 5-property portfolio on the market right now. The first call for offers was March 31st, which couldn't have been a worse time. So everybody agreed, let's put that off to April 30th. We ended up with 10 offers. 2 of the offers came from brand new funds who've raised, $50 million, whether that was family money or, investment money. So that's a good sign.
Jesse, what are you seeing on your end?
Yeah, I'm seeing and feeling very much the same. To your comment about, single tenant net lease stuff or retail, boy, I'd hate to have a single tenant building where, my one tenant calls and says, I can't pay my rent this month. You don't have a whole lot of options there. Whereas we do, right? We've got hundreds of tenants in place. So if you've got a 2 or 3 or 4% that need a little bit of help through this time, you're still able to pay your mortgage. And I think, the crossover buyer that's really been dancing in our marketplace over the last few years understands that because they felt pain from their other asset classes. One of the funds that we're working with is, they have an adaptive reuse retail fund that they really, it's how they got started in real estate. And they're putting no money into that right now because, that's highly volatile. So, owners that were around, investors that were around at any capacity through the last recession understand the dynamics and the positives of what we could potentially face over the next 6 months. And they're posturing to put their money in our marketplace because we fared so well the last time.
Yeah, we have a few individual private placements that are coming up, and we've had, although a lot of interest in folks that are wanting to invest in our properties, we're anxious to see, as this plays out and the timing of it. There are, for as many people that are ready to get into self-storage, there are as many people that we've had that have been investing in our projects for a while that are a little skittish and just holding on to cash. And so I believe that the activity level and the velocity of these are going to be the same. And some of the folks I've talked to that have these funds, that are setting up some funds in the $20-30 million range, they're not having a whole lot of issue in raising capital and filling those up. But it'll be interesting to see nevertheless. Let's talk briefly. I want to talk about, go ahead, Ann.
Well, I was going to say, my experience the last few weeks and conversations I'm having, the frontline operator, such as yourself, they are very, very bullish on this, and they understand, and they're still transacting, and the motivations are still moving forward. What I'm finding, though, is that the passive money, the money coming into these funds that aren't on the front lines of the operations, they're the ones getting skittish. But for us who are on the front lines, who understand the business, it's business as usual. But we talked to somebody who needed to raise, just about $300,000, and 3 weeks ago, the people were jumping up and down saying, yes, put me, I'm an investor. Now they're like, I think I'm going to hold on to my money.
Yeah.
But so if when you're in it, you believe in it, you understand that this is a phenomenal investment. But when you're passively just sitting on the sidelines and you're not directly involved, that's the skittish ones.
Well, and that is up to us. Certainly a person convinced against their will is of the same opinion still. So as we put these in front of folks, it's not our job to persuade them or convince them anything. Logic should draw them to the conclusion as to whether they want to invest with us or not. The good news is that, for the lenders, we layer this private equity on top of the debt. And from what you mentioned at the top of our call, and the lenders are, they're adding an extra layer of conservatism on top. Debt service coverage ratios are from 1.25 to 1.3. They're coming down on the LTVs by about 5%, amortization from 25 to 20. So kind of the rule of fives across the board. They're doing that, but at the same time, simultaneously, we are also stress testing the NOI and really just putting an overdue almost burden on these facilities as we underwrite them. And if they still pass muster, then we're still going to go through and invest in them. And, essentially, if we throw almost everything at this thing and we can see that it still is going to profit on the back end and get the returns to our investor, if we're convinced and we're the ones who are probably almost have more at risk, and I would venture to say that we do, than our investors. And if it passes muster and we're interested in it, then we'll bring our folks into it as well, and it should outperform. So I guess a lesson, not only do as we do, but for the lesson for everybody else out there is that if it doesn't work in this environment the way you're underwriting it, and you're hopeful that the environment's going to turn around and it'll shine if and when things turn around, I would prepare for a bad environment. And if it still passes with the numbers and underwriting where it is right now, then you should move forward. And so if it passes in a bad environment, it should pass in a good environment as well. So underwrite to the worst case scenario. So that was gonna go ahead, Jesse.
On your underwriting, I will tell you over the last few weeks, from lenders, appraisers, and buyers alike, the level of questions that are coming in regards to pro forma income is different than it has been over the last 6 months to 3 or 4 years. So, where I've seen people buy with year one numbers showing massive increases to the top line revenue, almost like where you wave a magic wand and all of a sudden, because there's a change of flag out in front of the store, I'm going to bring in an extra $80,000 or $90,000 a year. Investors, appraisers, lenders want to be able to quantify that income. So, let's really dig into the rent roll. Let's see how many units are occupied below street market rents. Let's compare that to the rest of the market to make sure that, if you start ticking people up, that they're not going to have an outlet to go somewhere else. Let's talk about, the potential for your receivables, your age of receivables to be growing over the next 6 months. And let's really make sure that what we're penciling out in our pro forma is attainable. If not, we have to default back to the trailing whatever month's income, depending on where the property is through lease up, and hang our hat on a trailing NOI versus a year one or year two or year three NOI. Same thing with C of O deals and lease up deals. We're feeling a little bit more stress from the buying pool and from the lending pool that, on the lease up projections through stabilization, that it could be taking, 18 to 24 months longer to stabilize those assets than they had penciled in the past few years on, similar types of deals and similar types of markets.
Yeah, the level of questions that we're getting from the lenders has been quite a bit different in terms of both underwriting the borrower as well. They're taking a healthier look at liquidity and bringing in, we're requesting additional guarantors if the liquidity isn't there and can be proved for the amount of the loan. And yes, there, banks, as much as we get frustrated with them and them, holding back and hitting the pause button on things, I'm beginning to see and understand why. And that is for the reason that you just mentioned, Jesse. And that is, okay, in a normal environment, from what we've had for the past, 8-9 years, we could pretty much predict what is going to happen. And that the consultants' numbers that we get from the feasibility study, probably dead on. But, the value in waiting right now is, okay, well, we're in a different environment. So let's see how this affects the leasing activity over 1 month, 2 months, 3 months. And so, we'll still look at existing facilities, but a lease up or a brand new construction without the history, I get it. And I understand it, as much as frustrating as it is, but, time will tell. The standard, 3% increase in revenue or occupancy, and 2% or 3% in expenses, that's kind of been thrown out the window right now. And they're looking at trying to gather as much data as possible and starting from a new baseline than where they were before. So that was that was going to be my next question, but I think we answered it without actually asking the question, which is the valuations and what to expect. So let's talk now a little bit about the investor, who is, you could say, on the passive side, but more focused on the active side. Somebody who's looking to either scale up or to begin investing in self-storage right now. Outside of what we've already talked about, tell me some of the things that they, from your side, and you folks have worked with a whole lot of folks that are new and looking to get into the business. What are some of the conversations you're having with those folks right now, or type of words of wisdom, gotchas, advice, if you will, that you would tell them right now as they're heading into the marketplace for the first time and in this new environment?
Do you want me to go first? So, yeah, be patient. If you're just coming into the business, just be patient, do your due diligence, look at a lot of deals. The deals are out there. I hate the word deals. The opportunities, it's a better word. They're out there, but just be patient and continue to look. But Jesse hit on a point that I've been kind of coaching people on over the last couple of weeks, and that's be careful on your pro formas, and be careful as you are, don't take the owner's P&L for granted. Don't just look at it and slap a cap rate on there and think that you've got a 10 cap deal. Peel back the onion, really, really understand it, dive into the market. If there's new supply in the market, understand how all that new supply has leased up, what's been the average lease up, and what have they done with their rates over the past year. And then talk to lenders. I've kind of gone in and out of cycles in my career. I've been doing this going on 14 years. Prior to every proposal, every listing, I used to pad my marketing packages with true lender quotes. And we get to going so fast, and we start just doing boilerplates, because after a while, that's what it is. It's boilerplate loan terms. But I've challenged myself and my team now to go back and before we ever even talk to a client about the value of their property, much less take it to the market, we have got to have 3 solid lender quotes. And we're looking at your local, regional, your relationship bank, credit unions, SBA. Understand their timing. What are they looking for? And what are you, Mr. Investor, what are you going to have to put up? What kind of financials are you going to have to put up? What does your own balance sheet look like? So that's kind of my coaching right now.
How about yourself, Jesse? How'd you answer that differently?
I get a lot of questions about timing the market. So folks, as we're positioning properties for sale in the marketplace, we're talking with buyers, everybody wants to try to time the market. And, I understand the value of that. I understand the significance, and I understand the desire for folks to, try to get the best deal they can get. I advise them, instead of trying to time the market, just have a very disciplined investment strategy and stick to that. So, from as simple as a cash on cash return, or, basis points over your interest rate, or whatever your buying model is. I don't care what it is, IRR driven. If a deal makes sense right now, jump on it. don't sit back and assume that there's nobody else out there buying, because there are other buyers, and they will step in. And, we've lost on deals because our buyers that we were representing hit the pause button. They wanted to wait and see, and somebody stepped in front of them and they lost a good deal. There probably will be opportunities over the next year to 2 years for people to look at and consider for investment some distressed assets. If it's anything like 2007 through 2009, maybe 2010, a lot of those distressed assets are not distressed themselves. They're parts of portfolios that owners had that had assets, other product types that caused the domino effect. So, the self-storage asset that was performing well is positioned on the market through, some sort of REO or some sort of distress sale, and everybody's fighting for those deals. I do talk with a lot of guys that are preserving capital, waiting for those deals. And I honestly think what's going to happen is, you're going to sit on a stockpile of cash waiting for that opportunity to come, along with 10 or 12 other people, and they're all going to fight for that deal. And all of a sudden it's not going to be that great of a deal anymore, because we're going to compress the cap rate through competition. So, in compiling and sitting on that cash, you've let 5 or 10 other deals potentially go past that were good, solid investment opportunities with upside. So stick to your model. Understand that you may have to rewrite your model. Like Ann said, you may have to adjust your equity requirements, adjust your interest rate requirements, adjust what cap rate you're buying, or how that impacts your IRR. And I'd rather see you be active today on a deal that makes fundamental sense with an adjusted cap rate than just sit and wait for some opportunity that you think you're going to, some optimistic acquisition that you think you're going to be able to manhandle a distressed seller. Because I don't know what the face of that acquisition model looks like in a year from now.
Yeah, clearly, if this is uncharted territory that we're in right now, and we don't know exactly what this is going to look like and how it's going to play out. If it follows suit from the last recession, of course, the last recession, the difference was that real estate is what caused it, and so therefore the valuations did go down. But regardless, the banks react in the same manner, and when these owners that own facilities right now, if they're not creating value, and when it comes time to refinance, and they haven't built up enough value in their facility, and they've got a 85-90% LTV loan right now, and they're looking to refinance in the new lending environment, which now they're only going as high as 70, 75, who knows what that looks like. Then if they haven't created enough value, then they're going to have to come to the closing table with money, or come to the closing table with the keys. And that's what everybody expects, to be able to swoop in and do a short sale, or let it go back to the bank and pick it up. But to your point, Jesse, who knows what the cap rate's going to look like, and if interest rates are higher, that's going to compress the cap rate as well. So, is it really a good deal at that point? And my own thought, or my own take on it, is that by that time there will be more folks that will be coming in to the marketplace, seeing once again, looking around, now getting ready to pull the trigger on self-storage. And at that point, there'll be more folks that aren't familiar and won't know how to underwrite, and they will be overpaying and outbidding, and causing, in my opinion, more competition, which means less opportunity. So I do believe that now is the time to do it. But those folks that are still savvy at underwriting and understand how value can be created and how to truly value a facility for where it is now and where they can take it, and the environment when they exit, those are the folks that are going to win anyways. And if you do lose out to folks that outbid you, then count yourself lucky that you didn't get caught up in the in the wanting to win that bidding process and end up with something that you don't really want anyways. So all that to say, if we could sum that up, is that smart underwriting is smart underwriting no matter the environment, and use the information that you have in front of you. You work with brokers like yourselves, Ann and Jesse, to get good broker's price opinions, bring in a consultant if necessary on top of that. But there are opportunities to be had out there, as long as you know what you're looking for. You can't just jump into self-storage and assume that it's going to work because you read an article on how it does so well during a recession, and it's not foolproof. So with that, guys, I appreciate your time. I want to be mindful, because I know you, like everybody else in our industry right now, we've got an awful lot happening, a lot of activity out there. So I want to thank you both for your time. But any parting thoughts, words of wisdom for our folks before we sign off for today? Ann?
Just, keep looking forward, be cognizant of what's going on, but the fundamentals of this business are still very, very strong. And I would have said this 2 months ago, and I'll say it now, and I'll say it 2 years from now. Solid underwriting, good fundamentals. You won't make an investment mistake in this asset class unless you just, kind of think you know it all. But be prudent in your underwriting. Go find your lender. Go find a property. Get in. It's a great business. Build wealth. Become a millionaire.
Great. Thanks, Ann. Jesse?
Yeah, I couldn't say it any better. But, I'll add to that. Folks that are getting started in the business right now have a competitive advantage over folks that started 10 years ago. And that advantage is folks like you, Scott, are disseminating information to help people educate themselves on how to find good deals, how to communicate with owners, how to research, how to underwrite, how to safe harbor their investment, how to safe harbor capital for their investors if they've got investors, how not to over leverage, how not to make mistakes. And I applaud you for doing that. I applaud the folks that you're sharing this information with for actually tuning in and gathering that information. And my advice to them is take what you're hearing here, take what you're learning as part of these, these podcast sessions and some of the other literature that's being disseminated down through different various sources, and take that back to the market. A lot of the owners that we talk to, they're not connected with the investment world, right? They're not connected to the capital markets like Ann, saying that she's interviewing 5 or 10 lenders for every single deal to talk about in real time. This is the debt package that impacts your investment. And this is what somebody's going to be allowed to pay for your property based on the NOI. And if your investor and your student and your partners that are out there educating themselves can take that information back and use that as part of their pitch to sellers, they're going to win deals that they otherwise wouldn't win, because they're providing that level of content and value and building or allowing that seller to build an understanding of why it's a safe bet to invest their time through a purchase agreement and potentially sale in the folks that you're working with, Scott. So I think that's very important, to take back what you're learning and communicate it in real time with folks that can make a decision on selling real estate.
Yep, very, very good point. Regardless of whether you've been in self-storage or real estate for a week or for 10 years, your responsibility is to educate the marketplace, and that means your seller, and that only benefits you and as well as then the rest of the marketplace in general. So yeah, take that information and go back and build a sound reason as to why you arrived at the price and the valuation on their facility. And if you can't come to an agreement, then you act as a consultant to determine how this property transacts, whether it's you or not in the future, and that will only serve you and your seller well. So Jesse, Ann, thank you both so much for your time. I appreciate it, and look forward to getting beyond this and seeing you all in the same room again sometime very soon. Thanks, guys.
Thank you.
Thank you, Scott.
Ladies and gentlemen, thank you for listening as always. Now, we're going to be talking about topics like this that are on target for the times that we find ourselves in. So it is important that you are listening to this podcast every single week, because the guests that I'm going to be bringing on and the topics we will be covering are relevant to what we are all going through right now. And it's just going to get better and better and better in terms of the content that we're going to be discussing, and it's going to be more timely than ever. So please, make sure you subscribe to the show and make sure you're paying attention to these episodes as they are coming out during this period, as I am specifically going out and finding guests who are providing really valuable information you need right now. So thank you so much. We'll see you next week.